Welcome back, everyone. Today, we're doing an explainer on something incredibly powerful for those of you who already know your way around the crypto markets. We're looking at a market maker tool called PairStacker. Now, historically, this kind of algorithmic accumulation software was locked completely behind the closed doors of major institutional funds. But today, it's actually available for personal exchange APIs. So we're skipping all the beginner fluff today to give you a highly structured, practical analysis of exactly what this is and how veteran traders are setting it up right now.
Okay, let's dive right into this. Here is our roadmap for today. First, we'll talk about coins versus dollars. Second, how the algorithm actually works. Third, who this tool is realistically built for. Fourth, a practical setup guide. And finally, the harsh risks and limitations.
So starting off with section 1, coins, not dollars, the paradigm shift.
Look, before we even touch an API key, we really have to challenge the standard mindset that traps so many retail traders. On the left side here, we have standard trading, right? The goal is simple: increase your fiat profit. You buy a token, you hope the dollar value goes up, and you sell. But on the right, the PairStacker approach shifts the goalpost entirely. The focus here is aggressively accumulating a specific asset. You aren't trying to end up with more US dollars at the end of the day. You're trying to end up with a larger stack of Bitcoin or Ethereum, totally regardless of its fiat price on any given Tuesday. Accumulate coins, not dollars. Think about it. If you fundamentally believe in the long-term value of a specific asset, sitting in cash and just waiting for dips is horribly inefficient. The core philosophy here is that mathematically exploiting the natural everyday market volatility to passively generate more units of your chosen asset is the ultimate long-term play. It's really about leveraging the daily noise to build up your stack.
Let's move to section 2, how the algorithm works. Under the hood.
So how does this automated rotation actually function while you sleep? Well, the engine driving the whole system is mean reversion. This algorithm doesn't care about the news, and it definitely doesn't try to predict breakouts. Instead, it relies purely on the statistical tendency of a trading pair's price ratio to eventually return to its historical average. It's constantly monitoring the ratio between two assets and basically just waiting for the math to break down.
Now check out how the bot trades at these extremes. The first bar here shows the normal, boring historical average, but suddenly the second bar shows a spike. One asset has become statistically overbought compared to the other, hitting a predefined percentile boundary. And this is exactly where the algorithm strikes. It automatically sells the overbought asset and buys the underpriced one. Then in the third bar, when the ratio inevitably drops back to the mean, it reverses the trade. It just cycles back and forth, skimming a tiny profit in extra coins with every single round trip. To make this all happen, the strategy rests on 4 main pillars. First is selection, picking highly liquid pairs. Second is range, defining your moving averages and those extreme percentiles. Third is automation, letting the bot handle the split-second API execution. And fourth is control. Now this one is absolutely vital. While the execution is automated, the strategic risk management remains entirely in your hands. You are the architect here. The bot is just your builder. Bringing us to section 3, who is this tool actually for? The target profile. Let's set some brutal expectations right now. If you're looking for guaranteed passive income without putting in any effort, just look away now. This tool is built for a highly specific profile. It requires experienced traders who actually understand statistical risks. It's absolutely perfect for long-term hodlers wanting to put their dormant bags to work. And, crucially, it requires technical enthusiasts. You really must be comfortable navigating API management, setting up hosting environments, and taking absolute personal responsibility for your setup.
Which perfectly segues into section 4, the practical setup guide, the execution framework.
All right, this is the most crucial part of today's explainer, the actual step-by-step blueprint. Trader to trader, here are the 4 concrete prerequisites you need before even thinking about booting up the script. 1, an account on a highly liquid exchange. 2, carefully generated API keys. 3, your base capital pre-allocated into your chosen trading pair. And 4, a secure, highly reliable VPS or server. You literally cannot run a market-making script on a laptop that might go to sleep. You need rock-solid 24/7 uptime. I need you to burn this rule into your memory right now. Never, ever enable withdrawal rates on your API keys. Look, when you are trusting third-party software or even your own custom scripts, your API keys should only have permission to read data and execute trades. That's it. That is the absolute golden rule of API security. If you follow this strictly, even if your server somehow gets compromised, your funds simply cannot leave your exchange account.
So, once your infrastructure is locked down and secure, you enter the tuning phase. And guys, this is where you earn your keep. You choose your target asset, select its pair, and configure the historical analysis period. You have to set your percentile entry borders, basically deciding exactly how far the ratio must stretch before a trade triggers, and finally, size your orders. This requires a deep, localized understanding of your chosen pair's unique volatility profile. Please do not just copy-paste someone else's settings. That is a recipe for disaster.
Finally, Section 5, Harsh Risks and Limitations, the reality check.
As every veteran trader knows, absolutely nothing in this space comes without a catch. This strategy is a delicate balancing act. Yes, the pros are fantastic. You get emotionless automation, strict discipline, and direct asset control. But the most dangerous risk factor on the board here is one-way trends. Mean reversion relies entirely on prices snapping back. If a massive, fundamental narrative shift happens and, say, Ethereum permanently outperforms Bitcoin without pulling back, you're going to find yourself trapped on the wrong side of the algorithm, and you will actually lose units of your target asset.
To be abundantly clear, this does not guarantee passive income. Keep in mind, every single trade costs an exchange fee. If you tune your percentiles too tight during a period of massive volatility, the bot is going to overtrade, and those exchange fees will just slowly bleed your account dry. You cannot set it and forget it. It demands active market understanding and periodic retuning. So, we arrive at the ultimate question for your trading strategy. Are you ready to automate your accumulation, or do you fear the trend? This tool offers an absolutely incredible, mathematically driven way to build your portfolio without adding fresh fiat. But it demands respect, technical discipline, and a strong stomach for statistical risk. Assess your own risk appetite, dive into the math, and decide for yourself. Thanks for joining me for this explainer, and I'll see you next time.